You know, when siblings inherit a piece of property together, it feels like a family matter, right? But in the eyes of the IRS, it's a really complex tax event. That seemingly simple idea, one sibling buying out the others, actually kicks off a whole cascade of rules that can be super counterintuitive. So, let's dive in and untangle the specific tax code that governs these surprisingly complicated family deals.
All right, here's how we're going to break this down. Think of it as the inheritor's journey. First, we've got to lay the groundwork with the basis step-up. Then, we'll walk through the friendly, amicable buyout. After that, we'll tackle the money side of things, debt and deductions. Then we'll look at what happens when things go south. And finally, we'll cover the really crucial reporting steps to keep you out of trouble.
Okay, before we can even begin to talk about a sale or a loan or a lawsuit, we have to start right here. Understanding the stepped-up basis is, and I'm not exaggerating, the single most important concept in this entire process. It is the main tax shield that the government gives to heirs, and pretty much every single calculation we do from here on out is built on top of it.
So what is this magic bullet? Well, it's Internal Revenue Code Section 1014, and it's powerful. Let's say your parents bought a house for $50,000, and when they pass away, it's worth $500,000. That $450,000 gain? Poof, it's wiped completely clean for tax purposes. Your new cost basis as the heir is now $500,000. The whole point is to stop you from getting taxed twice, once with an estate tax and again with a capital gains tax. And here's the kicker. This applies even if no estate tax is actually due.
Now, how you get that step up? That totally depends on how the property was owned. If it was a joint tenancy or a tenancy in common, only the share that belonged to the person who passed away gets the step up. But now, look at that community property line. Whoa, this is a total game changer. Thanks to a special little rule in Section 1014b6, if you're in a community property state and one spouse passes, both halves of the property get a full step up. That is a massive, massive advantage for surviving spouses in states like California or Texas.
Okay, so we've got our stepped-up basis. Now let's move on to the most common scenario. One sibling wants to keep the family home and decides to buy out the others. You have to understand this is not your typical real estate deal. The IRS looks at transactions between family members with a magnifying glass, and they have a very specific set of rules, especially under Section 267, that you absolutely have to know about.
Let's look at this from both sides of the table. For the sibling who is selling, it's usually pretty straightforward. Their sale price is probably the same as their new stepped-up basis, so zero gain, zero tax. But here's the trap. What if the property value went down after they inherited it? They've got a real loss on their hands. Too bad. Section 267 basically says, nope, you're family. You don't get to deduct that loss. Now, for the buying sibling, their new basis is sort of a hybrid. It's their original inherited piece, plus the cash they paid for their sibling shares.
But let's be real. Families don't always do things at fair market value, right? It's pretty common for one sibling to give another a family discount. Maybe a share is worth $200,000, but they sell it for $150,000. Well, the IRS doesn't just see a cheap sale. They see something called a part sale part gift deal. And believe me, it has its own set of very peculiar rules for basis.
And this brings us to one of the truly weird parts of the tax code. Okay, stick with me. Under Treasury Regulation 1.115-4, the buyer's basis for figuring out a future gain is the greater of what they paid or what the seller's basis was. So in our example, the seller's basis was $200K, the buyer only paid $150K, but the buyer's basis is still $200K. It's a neat trick that keeps tax basis from just disappearing within the family. But of course, there's a catch for calculating a future loss. For that, the basis can't be more than what the property was worth when they got it.
So, the deal is done, on paper. Now for the hard part, coming up with the cash. This brings us to financing the buyout and a huge potential pitfall, trying to deduct the mortgage interest. The IRS is extremely strict about this, and it all boils down to whether your loan qualifies as acquisition indebtedness.
Under Section 163H, the rules are crystal clear. You want to deduct the interest? Fine. The debt has to be used to acquire a piece of the home. And, this is the important part, it absolutely must be secured by that same home. The good news, borrowing money to buy out your brother or sister, that counts. The bad news, it all comes down to the paperwork.
Okay, listen up, because this is probably the most common and costly mistake people make. A simple handshake deal, a written IOU between you and your sibling, that is a tax disaster for the buyer.
If that debt isn't formally secured with a recorded deed of trust or a mortgage, the IRS says all that interest you're paying is just non-deductible personal interest. Every single dollar of that deduction is lost. It's a fatal flaw.
And if you think you can be clever and get around this with a zero-interest loan, nope, the IRS is way ahead of you. They have this thing called Section 7872 for below-market loans. It basically forces you to impute interest. They just pretend there's interest being paid at a rate they set. So the selling sibling ends up getting taxed on phantom income they never even got, and the buying sibling is treated as paying it. Then that foregone interest is treated as a gift, which might mean you have to file a gift tax return. So far, we've been on the amicable path. But what happens when siblings just can't agree? Well, that leads us down a much more contentious road to something called a partition action, which is just a lawsuit to force the sale or division of the property. The legal fees can be huge, and the big question is, can you deduct any of it? The answer is a frustrating, it depends. The legal standard for this actually comes from a Supreme Court case, United States versus Gilmore. It's called the origin of the claim doctrine. And what it means is that the tax treatment of your legal fees has nothing to do with why you're suing. It's all about the fundamental nature of what you're suing for. Are you fighting over who owns the property, or are you fighting over the income from the property?
And this is where two parts of the tax code go head-to-head. On one hand, you have Section 263, which says any cost to defend your ownership, your title, is a capital cost. You can't deduct it now, you have to add it to your basis. But on the other hand, you have Section 212, which says any costs you have to produce or collect income, like fighting over rent money, are deductible. The headache is that a single lawsuit can involve both kinds of claims.
There's a perfect case that shows how this works: Cawthron versus Commissioner. In that case, the taxpayer was fighting to protect her ownership interest in a property. And since the origin of her claim was all about title, about ownership, the court said, sorry, those legal fees are capital costs. They were not deductible, even though the whole thing ended with her getting a cash payout from a sale.
So what's the practical takeaway? You absolutely have to tell your attorney to bifurcate their bills, to split them up. Any fees related to proving your ownership percentage, those get capitalized. Costs that are directly tied to the sale, like a court referee's fee, those reduce your sales price. But, and this is key, if you are specifically fighting over an accounting of rental income, those fees can be deducted right on your Schedule E against that very income.
All right, we're in the home stretch. We've talked basis, buyouts, and lawsuits. Now let's talk about the final step, the paperwork. We have to figure out if our gain is long-term or short-term and how to report all this correctly to the IRS so we don't set off any alarms.
You know, the IRS isn't always the bad guy. They give heirs a really nice break with Section 1223(9). Normally, you have to hold an asset for more than a year to get those sweet, lower long-term capital gains rates. But for inherited property, the IRS just says, you know what, we'll just call it long-term automatically. It means you could literally sell your share one day after inheriting it, and any gain would still be taxed at the better long-term rates.
But just when you thought it was safe, there is one last massive trap, and this one is for the sibling who bought everyone else out. Your holding period is literally split in two. The share you inherited is automatically long-term, that's great. But the shares you purchased from your siblings, the clock on those starts ticking the day after you buy them. So if you turn around and sell the whole property within a year, the gain on those purchased shares is going to be short-term and it'll get taxed at those much higher ordinary income rates. Ouch.
Okay, let's wrap this up with a quick compliance checklist, the stuff you absolutely have to get right. On Form 8949, where it asks for the date you acquired it, you write one word: inherited. If you had one of those disallowed losses, you have to use code L to report it. If there was a gift of equity involved, the seller needs to file a Form 709. You'll almost always need a Form 1099-S, and as we hammered home earlier, you have to perfect that security interest to deduct the interest. Getting these details right is everything.
Which really leaves us with one final, kind of tough strategic question. We've seen how the friendly family buyout can be an absolute minefield of complex basis rules, disallowed losses, and financing traps. A court-ordered partition sale feels hostile, and it's expensive, but it does create a clean, arm's-length transaction with very clear tax results. So, is the amicable path always the best one? Or can that forced, formal process sometimes lead to a cleaner, more certain outcome for everybody? It's something every family in this situation really needs to think about.